Majority of analysts price in Fed cuts in June following today's higher than expected inflation data. Our next guest is warning that we can't expect a soft landing just yet. Jeff Klingelhofer is Thornburg Investment Management Head of Investment, and he says the longer the Fed waits, the bigger the risk, and he's joining us now to explain. So you got the floor, my friend.
I think the conversation's just been fascinating, right? I agree completely. Next week is an incredibly important Fed meeting, but really it's just a continuation of what the Fed has already been telling us. They have to see inflation come down. A prerequisite to their own belief of seeing inflation come down is they have to see the consumer weaken. And as part of that, they have to see the unemployment rate move up. So the big story that we've been facing for the last year and a half now and continuing into 2024 is the resiliency of that consumer. But when you peel back the onion, you see all sorts of signs that just don't make sense, and they don't jive with the very high level strength that we're seeing. So you see a divergence in the household employment survey versus the establishment survey, right? They go in very different directions. Gross domestic product, GDP versus gross domestic income, telling two very different pictures. But the one that I can't square, and I think really points us that the consumer is in a much weaker spot than we're being led on to believe, is while yes, employment remains strong, they're depleting COVID stimulus. They're continuing to consume, but they're taking on more debt in order to consume, and they're defaulting on that debt at a higher level. And that's usually one of the leading indicators to a fall in sentiment and ultimately market stress.
Okay, so following on our conversation we just had, do the dots go to one cut this year? And if they do, and what you say is true, how alarming is that?
I think it'd be very alarming, but I don't think that they do next week. Right? The Fed also has a tenuous balance. They're trying to get inflation to come down, the miraculous soft or even no landing, what we're currently pricing as a market. And I'll give it to the Fed. They've been successful thus far in doing exactly that. But they themselves know that the economic textbooks that we all studied, we all learned from, the alchemy of low interest rates is over. Higher interest rates are having an impact. It's not only having an impact on the consumer, it's having an impact on corporations as well, right? Their borrowing expenses are increasing. It took a lot longer to get there than we would have imagined as companies termed out their debt. But the exact same side on the deficit financing side, the government's balance sheet is also having an impact, right? There's over $10 trillion of debt that has to roll over this year. That's more than a third of GDP. And so all this comes to culmination. The Fed has a very difficult balance. They're not ready to signal that to the market, but they will.
We've seen Powell, he's switched gears a number of times. He's pivoted a number of times historically and pretty quickly. I'm just wondering, do you think the potential is still there? And the reason I'm asking, he has been channeling his inner Volcker for some time now. And then you look at the charts of the 1970s of Volcker, where you got that double dip like that. Well, we're at the bottom. We've done one. Do we get another? So I guess my question for you is, do you think, you look at the inflation data today, have we seen the worst, or are we accelerating to the upside? Because that kind of informs everything we're talking about here with respect to the Fed.
Well, just to continue the conversation using a sports reference myself, I'm a tennis player, right? I think what the Fed is trying to do is to avoid the unforced error or the footfall, right? They're starting to see, and most inflation metrics that you focus on, we're lapping the easy side of inflation. And to your point, we're coming back into much tougher sides, right? So energy inflation is actually going up. The average consumer is feeling that pain, and I think that's exactly why, while I don't expect the dot plot to move next week, in coming months, I do expect it to, because inflation will remain firm. We're seeing that we're firmly anchored at 3%, and we're not going to continue to go lower. If anything, it might actually start to move higher.
So what does all of that mean for where the market's going and where you should be? Because you sound a little more defensive than some of the folks we've been talking to. How are you expressing that?
Yeah, I don't term it necessarily defensive in terms of saying we're absolutely heading towards a recession, but the signs are there, but it doesn't match up with market valuation, right? So PEs are near all-time highs, right? Credit spreads are near all-time tights. We combine that with there are emerging signs of weakness in the consumer. There are signs that corporations, there was just a survey out this morning, small businesses plan to hire at a much lower rate than they have been in the past. And this has real impacts on the economy and markets. And so where I am is really playing defense for our investors. On the equity side, focusing on companies with big moats around their businesses, focusing on defensive dividend paying companies primarily within the Eurozone and international space, and on fixed income, taking advantage of that inverted yield curve where you can get 6-7% relatively easy and in very defensive portfolios.
All right, Jeff, thank you.
Yeah, well, we have to leave it there, but a lot of great insights. So thank you for helping us continue that Fed discussion as always.